Hello, my name is Erik Jones, and I'm director of the Robert Schuman Center at the European University Institute. Today we're going to talk about banking union, which is the European Union's project to complete the internal market by complementing its financial institutions with a whole set of arrangements to make them a lot safer. So the purpose of this talk is really to explain what is this banking union, why do we need it, why is it so hard to put into place, and what it means if we don't get a banking union at the end of 2022 or at any time in the near future. Well, let's start with the easy bit. What is a banking union? You see, the banking union as defined in the European Union is really a set of three different institutions. One of them is pretty much fully fledged. That's a single supervisory mechanism for all the major banks in Europe that's run out of the European Central Bank. It uses a single rule book to describe what these institutions are meant to do and how they're supposed to keep themselves at least risk-free enough to ensure that depositors and other investors don't get unnecessarily hurt. Now, this single supervisory mechanism is a new innovation that sits on top of the national regulatory framework that existed beforehand. So banking union is not wholly new. It actually sits on foundations that we've always had, but it is qualitatively different because the single supervisory mechanism is applying the same standards across all these financial institutions. Now that's the first piece. Of course, if you're going to have single supervisors, if you're going to have supervisors at all, then you need to have some way to deal with banks that don't follow the rules. That's the second set of institutions. That's the single resolution framework and the single resolution funding mechanism. You see, when banks don't follow the rules, the regulators have to be able to suggest that something is going to happen. Now, this kind of decision-making needs to take place in standard ways, using standard procedures, in a very transparent fashion, but usually under extremely tense circumstances. So the first thing they had to do was to set up a framework for making those decisions so that the supervisors could actually have teeth in their enforcement of the rules. Of course, making the decision is only the first part. The second part is implementing the decision. And what you discover is that winding up banks that are in trouble is an expensive enterprise. So we needed a single resolution funding package that would allow regulators credibly to threaten to wind up banks, even very large banks, that would be very expensive to put into the resolution framework. Well, that piece is already in place as well. In fact, just recently, they decided to backstop the single resolution funding with the potential to borrow from the European Stability Mechanism. There's a third set of institutions that goes into the banking union. This is the European Deposit Insurance Scheme. And a European Deposit Insurance Scheme is meant to protect those people who put their money into financial institutions as depositors, particularly retail depositors who have small amounts of money at stake. It's meant to protect them at the same level across the European Union. Now, this is the piece of the framework that's not really fully in place. There are standards for deposit insurance that are roughly the same from one jurisdiction to the next, but there's no common European scheme. And the question is whether we can introduce this common European scheme and at the same time shore up the resolution framework while strengthening the single supervisory mechanism. Because although these institutions are in place, the way they're working at the moment is probably not at the level they should be. Now, when I describe it this way, it sounds almost obvious that we would want to complete this banking union. So I think it's worth asking, why is this banking union not already in place? Why do we have so much difficulty doing it? And the answer lies in the fact that having a banking union is not an obvious thing. In fact, the institutions that I just described did not emerge naturally in any of Europe's financial markets, or indeed in the United States or Canada either. You see, the obvious solution to financial market integration in Europe was not to have a banking union. When they completed the internal market at the end of the 1980s and the beginning of the 1990s, they thought briefly about creating a single supervisory framework, resolution framework, deposit insurance mechanism, and they decided no, that the easiest thing would be to follow the ethos of the single market and allow national regulators to take care of business within their own domestic economies, and then to keep an eye on those branches of their domestic banks that operated everywhere else. And they would use the same mutual recognition framework for banks that they used for other goods and services that traded in the single market. That was the obvious solution. The problem with the obvious solution is that the banks rapidly outgrew the ability of national regulators to oversee their actions or to finance their resolution. And despite efforts to come up with very complex joint multinational resolution schemes, there simply wasn't a credible framework in place to discipline these very large European banks. The initial effort that was made toward the end of the 1990s was to get the banks to discipline themselves. This was part of the Lamfalussy process, involving the banks in their own regulation. But we know that effort did not succeed. The banks became too risky, the regulators were not strong enough, and the situation spiraled out of control, which is why we had the great global economic and financial crisis at the end of the first decade of this century. Now, in that context, the European Union came up with another set of schemes to introduce more common mechanisms. And these more common mechanisms included a European Banking Authority, for example. But having more common mechanisms wasn't enough to stabilize the situation, even though this European Banking Authority could, for example, stress test the various banks across the European Union. Having stress tests doesn't mean as much if the regulatory authorities are unable to enforce the rules and they're unable credibly to push these banks into a resolution framework and at the same time protect depositors. Now, we saw that this was a problem in 2012. That's when the Spanish financial system got into so much trouble that efforts by the state to bail out the banks began to undermine the solvency of the Spanish state at the same time. And what was necessary was some mechanism to use or create funding that could be used to prop up the Spanish banks without undermining the Spanish state. But that direct recapitalization of Spanish banks, which was the proposal that was on the table, was only acceptable to some parts of Europe if there was a single supervisory mechanism to accompany it. That's why the single supervisory mechanism is probably the best articulated part of the banking union today. But having introduced a single supervisory mechanism, the logic of those other institutions immediately came into play: a common resolution framework and a common deposit insurance. The difficulty is that most banks don't want to be in a common deposit insurance, particularly with banks they don't understand well, don't do business with, and are not like them in terms of business models and all the rest. They look at the common deposit insurance scheme as a cost, not as a savings. And so as soon as the single supervisory mechanism came into place, and as soon as we began talking about this resolution framework and the European deposit insurance scheme, complaints started to arise across Europe that common funding of resolution of banks would represent a transfer from one country to the next, and that a common deposit insurance scheme would represent a transfer from strong banks to weak banks. Now, you might think that this is an argument that is unique to Europe, but if you were to look at the debates about resolution funding in the United States or in Germany, you'd find the very same arguments being made. Part of the reason that the whole debate about deposit insurance at the European Union level is so complex is because the unique financial institutions in the German context with their own deposit insurance schemes don't want to join with other banks in Germany, and alongside those other banks in Germany don't want to join with other banks across the European Union as a whole. Now, this kind of controversy is hardly new, it's not unique, but it's very important. It explains why there's going to be this major push to complete the banking union in the coming spring, and also why that major push is not likely to succeed. So what happens if this European banking union doesn't succeed? I think we'll have to look at two different things. One of them is that national regulators are going to assert ever tighter control because they know what happened the last crisis. And what happened the last crisis is that not exercising control got them into trouble. We're seeing that already. Financial markets are less integrated today than they were before the great global economic and financial crisis, and they're unlikely to become more integrated because national regulators don't want them to be. The other thing we're likely to see is greater pressure put on the European Central Bank, because when banks get into trouble, the lender of last resort are their national central banks and, by implication, the European system of central banks as a whole. This is the kind of strain that we don't want to see, because the more the European system of central banks is implicated in financing financial institutions that are in distress, the more controversy that's going to fall on the ECB, rather than where it should be, on the regulators and the banks themselves. So we're looking at the completion of the banking union as an essential prop to the stability of the single currency. And if we don't see it, we should expect strains to emerge in the way the single currency is perceived. This is not inevitable, but it's very likely, and we'll need to prepare for it.